Hey everyone, it's your name from Financial Literacy 101, and today we're diving headfirst into the exciting world of stock investing. Specifically, we're going to be covering the 5 golden rules that I personally use to build my own portfolio and that I still use to this day. Look, I get it, investing can seem like this big complicated thing, but it doesn't have to be. By understanding these 5 simple rules, you'll be well on your way to making smarter investment decisions and setting yourself up for long-term financial success. We'll break down each rule step by step, giving you practical tips and actionable advice that you can use right away. So whether you're just starting out or you're a seasoned investor, this video is for you. Before you even think about buying a single share of any stock, you absolutely need to do your research. This is non-negotiable, guys. Investing without research is like sailing without a map. You might get somewhere, but the chances of reaching your desired destination are slim. Research is the foundation of any successful investment strategy. It helps you understand the market, the companies you're interested in, and the potential risks and rewards. Think of it like buying a car, right? You wouldn't just walk into a dealership and buy the first car you see without even looking at the price, the mileage, or taking it for a test drive, would you? You'd want to know everything about the car, its history, its performance, and its reliability. The same meticulous approach should be applied to stocks. You need to dig deep and gather as much information as possible. The same goes for stocks. You need to understand what you're investing in. This means looking at the company's business model, its competitive landscape, and its growth potential. Are they a market leader or a struggling underdog? Do they have a unique selling proposition that sets them apart from the competition? These are crucial questions that need answers before you invest. What does the company do? Understanding the core business activities of a company is essential. Are they in a stable industry, or are they in a volatile sector that could be subject to rapid changes? Knowing what the company does helps you gauge its long-term viability and potential for growth. What's their track record like? Look at the company's history. Have they been consistently profitable, or do they have a history of losses? How have they performed during economic downturns? A company with a strong track record is generally a safer bet than one with a history of volatility. What are their financials looking like? Dive into their financial statements. Check their balance sheet, income statement, and cash flow statement. Are they carrying a lot of debt? Do they have a healthy cash flow? Financial health is a key indicator of a company's ability to weather tough times and capitalize on opportunities. There are tons of resources out there to help you do your due diligence. Websites like Yahoo Finance, Google Finance, and even the SEC website are all great places to start. These platforms offer a wealth of information, from financial statements to analyst ratings and market news. Use them to your advantage. Read analyst reports, check out the company's website, and see what other investors are saying on forums and message boards. Analyst reports can provide valuable insights and professional opinions, while forums can offer diverse perspectives and real-world experiences from other investors. The more information you have, the better equipped you'll be to make an informed decision. Don't rely on a single source of information. Cross-reference data from multiple sources to get a well-rounded view of the company and its prospects. Remember, knowledge is power, especially when it comes to investing your hard-earned money. The more you know, the better your chances of making a profitable investment. So take the time to do your research thoroughly. It's an investment in your future success. Imagine putting all your eggs in one basket, and then you drop the basket. All your eggs are now broken, and you have nothing left. Not a good situation, right? This is a simple yet powerful analogy for why diversification is crucial in investing. That's essentially what you're doing if you're not diversifying your investment portfolio. By putting all your money into one stock or one type of investment, you're taking a huge risk. Diversification is all about spreading your risk across different asset classes, industries, and geographical locations. This means not just investing in stocks, but also considering bonds, real estate, and even commodities. Don't just invest in one stock or even one sector. The stock market can be volatile, and different sectors can perform differently at various times. Instead, spread your investments across a variety of different companies and industries. This way, you're not overly exposed to the risks of any single company or sector. This way, if one investment takes a hit, it won't completely wipe out your entire portfolio. For example, if you have investments in technology, healthcare, and consumer goods, A downturn in one sector won't necessarily affect the others. Remember the saying, "Don't put all your eggs in one basket"? It's a timeless piece of advice that applies perfectly to investing. Well, in the world of investing, that's basically the golden rule. Diversification helps to manage risk and can lead to more stable returns over time. There are a ton of different ways to diversify, but a good rule of thumb is to have a mix of stocks, bonds, and other types of investments. Bonds can provide steady income and are generally less risky than stocks. Real estate can offer both income and potential for appreciation, and maybe even some alternative investments like gold or crypto. These can add another layer of diversification and potential growth. The key is to find a balance that works for your individual risk tolerance and financial goals. Everyone's situation is different, so it's important to tailor your portfolio to your own needs. Working with a financial advisor can help you create a diversified portfolio that aligns with your long-term strategy. They can provide insights and recommendations based on your unique circumstances. Remember, the market will have its ups and downs, but a well-diversified portfolio can help you weather the storms and come out ahead in the long run. So, take the time to diversify your investments. It might take some effort and planning, but the peace of mind and potential for stable returns are well worth it. Diversification is not just a strategy, it's a fundamental principle of smart investing. By spreading your investments, you can reduce risk and increase the likelihood of achieving your financial goals. So don't put all your eggs in one basket. Diversify your portfolio and set yourself up for long-term success. The stock market is a marathon, not a sprint. Just like marathon runners pace themselves for the long journey ahead, investors need to adopt a similar mindset. It's not about the quick wins or the immediate gains. It's about enduring the race and reaching the finish line with a strong, sustainable strategy. It's going to have its ups and downs, but over the long term, the market has always trended upwards. Historical data shows that despite periods of volatility and downturns, the overall trajectory of the stock market is one of growth. This is why it's crucial to maintain a long-term perspective and not be swayed by short-term market noise. Don't get caught up in the day-to-day fluctuations or try to time the market. Attempting to predict the market's next move can lead to stress and poor decision-making. Instead, focus on the bigger picture and the long-term potential of your investments. It's impossible to predict short-term market movements consistently. Even seasoned investors and financial experts can't accurately forecast market behavior in the short run. This unpredictability is why a long-term approach is more reliable and less stressful. Instead, focus on building a solid portfolio of quality investments and holding on to them for the long haul. Diversification is key. Spreading your investments across different sectors and asset classes can help mitigate risks and enhance potential returns. Remember, time is your greatest asset when it comes to investing. The power of compounding works best over extended periods. The earlier you start and the longer you stay invested, the more significant the growth of your investments. The longer you stay invested, the more time your money has to compound and grow exponentially. Compounding is the process where the returns on your investments generate their own returns, leading to a snowball effect of growth. Think of it like planting a tree. When you plant a seed, you don't expect it to become a towering tree overnight. It requires patience, care, and time. It takes time for a tree to grow and bear fruit. Similarly, your investments need time to mature and yield significant returns. The initial stages might seem slow, but with consistent nurturing, the growth becomes evident. You wouldn't plant a tree and then dig it up every few days to see if it's growing, right? Constantly checking and changing your investments can be detrimental. Instead, trust the process and give your investments the time they need to flourish. The same goes for your investments. Regularly review your portfolio to ensure it aligns with your long-term goals, but avoid making impulsive decisions based on short-term market movements. Give them time to grow and mature. Just like a well-tended tree, a thoughtfully managed investment portfolio can provide substantial rewards over time. Stay patient, stay focused, and think long-term. Investing in a company without understanding its fundamentals is like buying a house without looking inside. You need to know what you're getting yourself into. Before you invest in any stock, take the time to learn about the company's financials. Look at their revenue, earnings, debt levels, and cash flow. These are all key indicators of a company's financial health. You don't need to be a financial expert to understand this stuff. There are plenty of resources available online and in libraries that can help you learn the basics of financial statements. Remember, you're not just buying a piece of paper when you invest in a stock, you're buying a piece of a business. So make sure it's a business you understand and believe in. The world of investing is constantly changing. New companies are emerging, industries are evolving, and the global economy is in a constant state of flux. To stay ahead of the curve, it's crucial to stay informed about market trends, economic news, and any developments that could impact your investments. Make it a habit to read financial news websites, listen to podcasts, and follow industry experts on social media. The more you know, the better equipped you'll be to make informed investment decisions. Remember, knowledge is power, and in the world of investing, that power can translate into serious profits. So, stay curious, stay informed, and never stop learning. So there you have it, the 5 golden rules for successful stock investing. Do your research, diversify your portfolio, think long-term, understand company fundamentals, and stay informed. By following these simple rules, you'll be well on your way to building a solid investment portfolio and achieving your financial goals. Remember, investing doesn't have to be complicated. If you found this video helpful, be sure to give it a thumbs up and subscribe to my channel for more financial tips and advice. And as always, thanks for watching. Thanks.